Welcome back. Everyone take a moment to settle in, because what we're about to break down today is one of those situations where people either recognize the setup ahead of time or they get blindsided when the chart finally shifts. And honestly, most people right now have absolutely no awareness of how close we are to a macro trigger that could send waves across the entire crypto market, especially XRP. We're dealing with the reverse carry trade, institutions repositioning in real time, and a new regulatory pivot that Bitcoin maximalists are loudly celebrating without understanding that it actually strengthens XRP's position. So if you hold XRP, or you're trying to get a grip on where this market is moving next, stay sharp. This is not the moment to be casual. Before we dig into the reverse carry trade, which is where the real pressure point sits, I want to start with something that perfectly shows how disconnected much of the crypto community is from reality. You've probably seen Gary Cardone online. There's no need for sugarcoating. The guy openly despises Ripple and XRP, and he's built his whole internet persona around acting like anything tied to XRP must automatically be a scam or a joke. So when he saw the announcement that the US now has its first onshore CFTC-regulated derivatives marketplace for crypto, he immediately jumped in with his typical probably nothing sarcasm that Bitcoin maxis love to toss around. But here's the part those maxis completely overlook, and honestly, it's hilarious. That exchange he was hyping, that shiny new institutional derivatives venue he tried to applaud, that platform is deeply connected to Ripple, backed financially by Ripple, influenced by Ripple's leadership, and very likely, though not officially confirmed yet, getting ready to use XRP and RLUSD as collateral for derivative settlement. Brad Garlinghouse literally holds a seat on its board of directors. So while the maxis were congratulating themselves saying, "Look, institutions are arriving, big win for Bitcoin," they were unintentionally cheering for a major infrastructure advancement engineered by Ripple. They were celebrating the very market rails that XRP is poised to run on. And you already know what happens next. Once they realize XRP is an elemental part of that collateral framework, they'll pretend the entire exchange suddenly doesn't matter. That's the level of inconsistency we're dealing with. This is exactly how retail ends up wrecked. Half the loud voices in this industry don't understand institutional architecture. They don't read filings. They don't follow which companies are constructing the foundational plumbing of future financial markets. They just repeat whatever aligns with their tribal narratives. And if you trusted their surface-level takes, you'd completely miss the fact that institutional adoption of Ripple's technology is accelerating faster than ever. This is why your own perspective is critical. If all you ever look at are candlesticks, you miss the structural shifts below the surface, the shifts that eventually force price to catch up whether you're prepared or not. XRP's story has never been about retail hype. It's always been about infrastructure, the rails beneath the rails. And this derivatives exchange represents another cornerstone in that foundation. Which brings us directly to the next part of today's breakdown. The part people are genuinely uneasy about. The developing reverse carry trade, the whispers of tightening liquidity, and how all of this connects to XRP's current price movement. There is a macro imbalance forming here. And if you don't understand where the actual risk lies, and how much of it markets have already priced in, you are going to completely misinterpret XRP's next move. So let's strip out the emotion, cut through the noise, and get into the real mechanics, because the reverse carry trade is not what most people believe it is. And XRP's reaction has been far more calculated than people assume. Now that we've cleared the surface level distractions, let's talk about why this derivatives development actually matters, and why the majority of the crypto space is overlooking the bigger picture. The moment you bring up real infrastructure, collateral design, or regulatory frameworks, half the influencers in the industry go blank. They know how to scream price predictions. They know how to chant buy the dip. But the second you ask them to explain how institutional markets truly function, their entire framework collapses. And that's exactly what we're seeing with this CFTC-regulated exchange. The Bitcoin maximalists who praised this platform didn't bother checking the ownership structure. They didn't look into who funded the project. They didn't see who sits on the board. They didn't analyze the licensing strategy or the regulatory approval pathway. They saw the word derivatives, assumed it validated Bitcoin, and ran with it. That was the full depth of their analysis. Meanwhile, anyone who is actually paying attention sees something entirely different. Ripple is positioning itself at the center of regulated digital asset markets, not hype markets, not meme gambling, not leveraged casinos, regulated, institutional market structure, the exact place where long-term value is created. And it goes even further, because if this exchange incorporates XRP or RLUSD as collateral, and let's be honest, Ripple wasn't brought in for decoration, then XRP becomes a structural component of U.S. regulated derivatives flows. This isn't a speculative storyline, it's a functional shift in the design of capital markets. And here's the punchline. Maxis will never acknowledge this because it destroys their worldview. They've spent years insisting XRP can't be used in real institutional systems. So when the real world contradicts their ideology, they don't adjust. They deny, ignore, or pretend it isn't happening. This is why blindly following tribal thinkers is dangerous. They're not analyzing, they're reinforcing their biases. But here's what most people still miss. The biggest impact of this new exchange isn't even the headline, it's the domino effect. If XRP becomes accepted collateral in a CFTC-regulated environment, that opens the door to broader collateral systems, prime brokerage integration, stablecoin liquidity pipelines, corporate treasury operations, derivative margining structures, settlement netting, and more. Once an asset becomes structurally useful, institutions stop caring about online tribal drama and start caring about throughput, liquidity efficiency, counterparty risk, and regulatory certainty. XRP meets those requirements. So when people ask, is this bullish? They're asking the wrong question. It's not about bullish or bearish. It's about evolution. It's about strategic placement. It's about who is quietly building the financial infrastructure of tomorrow. If you can't see where this is heading, you're not even participating in the real game, which brings us to the reverse carry trade. While everyone is distracted with price dips, fear-bait thumbnails, and maxis yelling at each other on social platforms, the real pressure on the market has been macro-driven, structural, and months in progress. Jake Claver spotted it early, institutions saw it too, and positioned long before retail even knew the phrase existed. That's why the market reaction hasn't been a sudden catastrophe, but a slow grinding decline that people wrongly interpret as randomness. So let's cut through confusion and break down the mechanics of the reverse carry trade, what it is, why institutions moved early, and why XRP's chart looks exactly the way it does right now. This is the point where people finally understand the true weight dragging on the market. Here's where most people finally snap out of it. The reverse carry trade isn't some mysterious doom scenario. It's a structural unwind that has been quietly bleeding into risk markets for months. If you don't understand it, you're navigating a market being influenced by forces far bigger than crypto. But here's the key nuance almost everyone misses. Just because there hasn't been a dramatic crash doesn't mean the impact hasn't already been unfolding. Markets often price in danger months before retail notices. Smart money doesn't wait for a knockout punch. They react as soon as the fighter steps into the ring. So when people ask, will there be a flash crash? The truth is, it's possible, but not guaranteed. And it may already be mostly priced in. Crypto has already been grinding downward for months. XRP is deeply oversold. Market liquidity is thin. These are classic signals of a macro unwind, not a surprise attack. Now let's connect this directly to XRP. I'll be direct. The macro headwinds explain the selling pressure, but they don't erase XRP's long-term trajectory. In fact, XRP being this oversold is statistically unusual. Historically, whenever XRP enters this level of RSI compression, the outcomes have been massive percentage rebounds, 600% in one cycle, 130% in another. That's what deep macro oversold conditions create, asymmetric upside once the pressure releases. So instead of obsessing over whether the reverse carry trade triggers a dramatic event, the smarter question is, how much of the damage is already absorbed? Because if markets have already priced in disaster, even a mild resolution can trigger upside instead of downside. That's how bottoms form, not when everything improves, but when everything bad is already accounted for. The bottom line? Yes, the reverse carry trade has affected XRP. No, the market hasn't ignored it. And yes, there's a real possibility that most of the pressure is behind us. Here's the part where signal finally separates from noise. Everything we've discussed, the reverse carry trade, liquidity drain, institutional repositioning, lives in the short-term macro category. Important, yes. Permanent? Absolutely not. If your investment thesis collapses because of a temporary liquidity cycle, then you didn't have a thesis, you had a hope. So let's zoom out and look at what actually matters, the structural long-term forces forming behind XRP that have nothing to do with Japan, interest rates, or speculative fear. This is where long-term investors outperform traders, because traders obsess over every candle, while institutions quietly prepare for fundamental shifts that will reshape payments for decades. First, utility. XRP is one of the few crypto assets with genuine enterprise adoption. Not hype, not imaginary roadmaps, actual integration by major corporations and global banks. The interview with Reese Merrick made that impossible to ignore. The stablecoin, regulatory, approvals, G-Treasury integration, and corporate demand for instant settlement and automated liquidity. None of that disappears because of temporary macro tightening. Second, infrastructure is being built that aligns XRP exactly with where global finance is heading: treasury automation, cross-border settlement, on-chain liquidity management, stablecoin rails, prime brokerage systems. These aren't concepts, they're functioning systems built on the XRP ledger and Ripple's product suite. And most people still underestimate that when real institutional flows start using these rails at scale, retail chart speculation becomes irrelevant compared to the demand behind settlement liquidity. Third, the decoupling narrative. Yes, XRP still follows Bitcoin broadly. That's normal because crypto is not fully matured. But decoupling isn't a switch that flips. It happens when utility outweighs speculation. RLUSD gaining approval, banks testing stablecoin settlement, treasury modernization. This is the groundwork being poured now. So when people panic about XRP dropping 40% to 50%, they're thinking like short-term spectators, not long-horizon investors. Pullbacks don't erase adoption. They often accelerate accumulation from institutions, the same ones retail thinks are waiting to buy higher. Fourth, the reverse carry trade becomes irrelevant once liquidity cycles turn, and they always turn. Central banks tighten until something breaks, then they ease. Liquidity returns. Risk markets recover, and assets with real fundamentals rally first. XRP is positioned for that environment, not the one we're currently in. And the truth is simple. 5 or 10 years from now, nobody will even mention the reverse carry trade. Nobody will care about Japan's policy. Nobody will remember whether XRP dropped to $150 or $130 during a macro liquidity pullback. They'll talk about Ripple's integration into global payment architecture, stablecoin adoption, institutional settlement, treasury flows, prime brokerage rails, everything being built right now. The macro noise fades. The utility story compounds. And XRP was never designed to shine in hype cycles. It was designed for the institutional era that is only just beginning. Here's where everything ties together. The reverse carry trade, the fear, the liquidity drain, none of it changes the endgame. Short-term volatility can feel harsh, confusing, and draining, but the long-term path hasn't shifted at all. And this is exactly where most investors fail. They zoom in so close to the noise that they forget the actual signal. Strip everything down. The market has already priced months of fear. XRP is at extreme oversold levels we've only seen a few times. Historically, when XRP enters this zone, it doesn't just rebound. It snaps back with force, often triple-digit returns or more. That doesn't guarantee anything, but it makes one thing clear. The market has absorbed enormous negativity. The reverse carry trade isn't some hidden monster. It's a macro process markets have understood for months. Institutions moved early. Risk assets corrected early. The majority of the pressure may already be behind us. Could there be one more shock? Yes, but the market is not unprepared. What matters far more, and what will define XRP over the next decade, has nothing to do with Japan's yields or temporary liquidity cycles. It's about the massive structural transition happening right now behind the scenes. Ripple integrating with global payment systems, stablecoin adoption accelerating, Treasury onboarding major enterprises needing instant settlement and automated liquidity, the rise of RLUSD and its regulatory approvals, XRP being positioned as a settlement-grade asset for institutional operations, prime brokerage infrastructure forming with Ripple in the middle, financial institutions openly testing and adopting the technology. These aren't fantasies, they're not theories, they're not tweets. They're real integrations, real approvals, real infrastructure. And here's the part almost no one talks about. When real utility takes over, speculative fear cycles become irrelevant. The same people panicking now will eventually pretend they always knew. They'll forget the fear. They'll forget the macro doom. Because once utility dominates, narrative collapses under the weight of actual usage. In 5 years, nobody will care about the reverse carry trade. Nobody will care about whether XRP fell to $160 or $120. They'll only care about who positioned early. Your job is to understand the deeper structure, not react to every emotional ripple. As always, this is not financial advice. Do your own research, make your own decisions, and never depend solely on influencers or analysts to shape your financial future. Crypto is volatile, unpredictable, and constantly evolving. Only invest what you can afford to lose.